So today we're bringing a very hot and contentious topic to the forefront, which is this idea that Trump floated out, which is a 50-year and apparently in some ways even a 100-year mortgage. I don't know that I heard that one directly, but it's been floating around as one of the options, 50 and 100-year mortgage. So I want to go into, like, does this actually solve what it is at least presented to solve, which is an affordability crisis in housing?
Yeah.
Does it solve that? And if it does, how? And if it doesn't, what gives? Like, how is it solvable?
What solutions could there be?
Yeah. So I'm excited to talk about it because I certainly have some personal opinions on it. I'm sure you'll share some personal opinions as well.
Yeah.
But then I pulled up some really good stats. So we're excited for this episode. We would love comments to let us know what your thoughts are at the end of it. But here we go. Welcome to Loans Elevated. So here we are. Housing affordability is a quote-unquote crisis.
Yep.
One of my personal opinions is this crisis, I do agree, there's no question at all that housing is less affordable than it was in the COVID era.
Yeah.
But I feel like, similar to one of the most recent episodes you did with TJ about foreclosures and things, I think it was just last episode, similar to that episode, I feel like some of the data points are cherry-picked to essentially support this argument that housing is unaffordable. And it's an infectious idea that may not be totally true. But it spurred the President Trump, to float a 50-year mortgage. And there's some obvious issues there. The first thing, and there's really no order. I just tried to get my thoughts here, and then we'll just kind of dive into it. But let's just go into what I think is the more real problem about housing affordability first, which is it's not just the fact that mortgage rates went up and home prices have gone up. Mortgage rates, as we've seen, you look at these stats, historically, we're kind of just like right in the middle ground of where mortgage rates have always been. So it's more of like a feeling of loss from the super low rates. That it's more of an emotional reaction, not an actual mathematical reaction.
It's still the COVID hangover.
Right, exactly. Yeah. People are still obsessed. Now that's fading. Home prices obviously spiked. Those are two real things that are for sure. I'm not saying they're not making housing more expensive. They are.
Right.
But appreciation just kind of goes, and there's spurts where it's very significant and eras when it's a little lower. On the grand scheme of things, it's about 5% every year. We're continuing that trend on a long-term basis. That trend is and has continued basically for forever. Rates are at historic norms. People do talk about the idea of housing as an expense to total income, or house prices as an expense to total income. And I think I'll just start here, which is that is not a cause of mortgage rates or a cause of home prices. That, in my opinion, is a cause of home buyer expectations and demands from a generational basis. I feel like the younger home buyers are like, well, no, I need the 3-car garage. I need the badass house. I need the finished basement for whatever reason, even though it's just my wife and myself.
Yeah.
And, you've got these types of housing arrangements where it's overkill and the expectations are unreasonable. What do you think about that? I mean,
yeah, I think there is a role that consumerism plays today that really stems from social media. I mean,
yes. FOMO.
Exactly.
Comparison.
It's always been there. The keeping up with the Joneses has always been a thing, right?
Right. Even from the
But
50s.
it's even more infectious today because it can spread so quickly. And so you really wonder how much of it is a psychological issue. And I'm not saying you shouldn't be able to have your cake and eat it too. I think that's the beauty of a free market and
America
participating in capitalism,
Yeah. United
but
States.
It's not an entitlement, right? And I think that is something that we're struggling with. And I do really think it stems a lot from social media and the culture today.
For sure.
You think about, like, a lot of people like to make the comparison of, like, my grandparents or my parents were able to afford their life with just one income. But what we also don't realize is there was not a lot of extra. There wasn't like buying the new brand new $200 shoes. There wasn't going on the extravagant vacations and all the other stuff.
Or driving the badass car, and you have a couple of them,
right.
and then you have the Razor, and you have the fifth wheel, and you have all this other stuff, and then you got to go out to eat at the cool restaurant because you're going to see your friends and colleagues there, and like, I agree, it's a social expectation epidemic that we're living in.
Yeah,
that is more responsible than any one thing, in my opinion, for this quote-unquote housing crisis. Like, let's get real. Go buy a frickin' townhouse. And, yeah, you might have to cram kids in bedrooms, or it may not be the perfect house, or you might have to skimp on date night, and it might have to be a little cheaper or whatever. But
I think pretending that it would never come without any sacrifices where a lot of people are going wrong.
And it's not even pretending. It's demanding that I need my house, and there's no way I'm going to let go of my shopping spree, and there's no way I'm going to let go of the good restaurant and the vacation, like you're saying. That, I think that is the one culprit. If you had to name one thing, that's the most severe culprit of this quote-unquote housing crisis. Like, if it's a priority, make it happen.
Yeah, and yeah, exactly. And a lot of people will say, well, if you bought your first house prior to COVID, you just got lucky with timing. Like, I think of my scenario, to be specific. Like, we rented for a very short amount of time, my wife and I, and the 4 or 5 months that we were renting, we knew we wanted to buy a house. And so we had it on our radar. We were always keeping an eye on things. And I mean, my mother-in-law's in the business, so it did help having someone who could kind of give us some pointers. But I was also in finance. I worked at a bank. And so I understood it. And I think I was making like $14 an hour or something like that at the bank. Maybe some commissions. It's not really like we were not making a lot of income.
Yeah.
But we had saved up just enough for a 3% down payment over like just under a year's worth of time. We were good savers. I mean, we always kind of had that within us. So that helped us a ton, but I sacrificed on a lot. Like, I didn't buy a whole lot of clothes. Like, I remember even just for work at the bank, like if I needed new work attire, I would go to Kohl's and I would buy like the cheap stuff on sale. Like, we're talking like turtlenecks that were like $10 and wear those, right? Or H&M and buy them on sale. And we sacrificed for a long period of time. When like during that time frame, a lot of people were out partying, going to bars, like doing those types of things, spending the money, which is fine. I'm not
buying
like,
the cool cars,
whatever, like do that if that's what you want to do, but you're going to pay a repercussion at some point. And the sacrifice, you can't go without sacrifice. At some point,
my opinion is this: we don't need to have a social courtesy of saying, do whatever you want. We're talking about the reality of affordability of housing.
Yeah.
You have to take some personal responsibility, as is anything in life. Like, the rubber meets the road somewhere, and the rubber meets the road for everything. When it's all said and done and you distill it all the way down, you are responsible. And you have to make those choices.
Well, and I had to rent out my basement too. I bought a house that I knew I could rent out the basement because I needed it to feel comfortable.
Yep.
While it was short-lived, I mean, that was the only way I was going to do it. So again, another sacrifice. We didn't even have the house to ourselves for the first year.
Yep. And same goes with me. I had a very similar experience. Katie and I rented for a year, and we signed that lease. And the realtor, he's like talking about renewal options, and I was just like, it doesn't matter, dude. We're buying a house by the end of this. And we were just bound and determined. Right. But again, we didn't go shopping. We didn't do basically anything. We were chilling at home.
Ramen, hot dogs, canned chicken.
Yeah, it was like, dude, legit. We would set, and granted, these were different times. This was gosh, how long ago was this? Like 15, 16 years ago.
Yeah.
So it was different times. But we would set a budget of $500 per month collectively for both of us. That included fuel, groceries, entertainment, date night. That included everything. $500 a month. Like, I'm just like, how the hell did I do it, to be honest with you? I don't get it, but it was a priority. And same with you. My brother rented a room, and he rented a room from us for 4 years. We didn't have a house to ourselves as newlyweds and a couple in our first home for 4 years because, like, it was important. But what happened? That house went up in value. I was able to cash out, buy another house. That house doubled in value. And this was all before COVID. So these were in regular markets.
Yeah.
And I made hundreds of thousands of dollars owning real estate by virtue of sacrifices, short-term sacrifices.
Yeah.
And now real estate is a very meaningful portion of my net worth and my future retirement plans. Frankly, it is like the foundation of it. And so, anyway, that's just kind of like a personal bone that I wanted to pick. And so moving on from that, something a little more tactical here. Beyond rates, beyond home prices going up, I was thinking, okay, what else has happened? We've seen this in our industry. So these are real issues. There is some personal accountability that needs to take place, but there are real issues. On top of home prices and rates, insurance premiums have gone up between 30 to 100%, or in some cases, dramatically more than that on an annualized basis. We've seen it. Just in the past couple of years, like we used to quote typically like $50 a month for homeowners insurance on a single family home. We don't quote less than $125 a month now. Like we're 150% higher here in Salt Lake, which is crazy.
And there was such a lag there in insurance that I feel like it really
just like
was like a dagger, just at the worst time.
Dude, it was like a Mike Tyson hook.
Yeah, everything had gone up and everyone felt the pain, but then it's like, oh, we forgot about insurance and it needs to catch up because it's from an annual basis. And as they're getting these claims and they're like having to bail people out of these higher priced cars or assets or whatever, they're having to jack their premiums up. So yeah, it's been a nightmare.
So then property taxes, same thing.
Yeah.
Those have gone up by, I mean, you got to think, it was very common that a starter home max was like $200 a month in taxes.
Yeah.
Now we're at least $250, probably $3,000 a year.
Yeah.
So that's gone up like $50 a month. Insurance has gone up $75 a month. So now we're talking $125 a month just in fixed costs.
Yeah, and we're lucky here in Utah. It's non-disclosure. Otherwise, it would be
could be dramatically more.
Yeah.
Yeah, for sure. We should talk about that. HOA dues up dramatically. Like my personal HOA dues, I live in a community with only 7 houses, but we have to pay for snow removal on our site and landscaping, but it's very, very minimal, almost nothing. But just because snow removal and the cost to pay contractors to do work has gone up, my HOA has gone up $125 a month in 3 years. Yeah. That's double, dude.
No one's going to eat the bill. It's going to get passed on somehow.
Somewhere. And like, so HOA dues going up, but that's because labor for the people that do the services within your community, that's all more expensive. The materials for even just imagine like landscaping materials, all that stuff, it's all gone up. And that cost has to be, there's a burden on somebody somewhere. So that's gone up. That's not being addressed with this idea of a 50 or 100-year mortgage because it's only changing the amortization. And we'll talk more about that. But utilities and energy costs, those are up dramatically, like 30 to 70%, way up.
Yep.
Maintenance on houses, way up. Like Katie and I, our freaking fireplace won't light. We're thinking that there's like an issue with the flame sensor or something because the pilot light lights and then it just goes out and it won't actually light. We had to pay them to come check it out, $175 just to come see it. I'm like, okay, well, I'm not going to screw it up. You know, so.
It is crazy. And that stuff is always it always comes at the worst time too. I swear.
For sure. I know. Like right before the holidays, it's like, okay, I guess I'll write a $175 check to use my fireplace that I paid for.
Yeah.
Crazy. So anyway, these are some compounding pressures on top of the obvious ones that people like to talk about that are significant. So we're talking $125 a month, HOA dues. If you live in an HOA, I mean, let's just say that's gone up $50 a month, so $175 a month. Utilities probably gone up 50 to maybe more than that a month, so $225. So we're probably talking in fixed cost on the standard just entry-level home in Utah, an increase of $300 per month in actual just like ownership costs.
Yeah.
From just maybe 5 years ago, you know, probably over that time period. So there are real hurdles. So it's like, what gives? Is the 50-year or 100-year mortgage a solution? And so I ran the math because I love running numbers. So compared to a 30-year, a 50-year mortgage, this is assuming that you get the same rate on a 50-year that you would get on a 30-year.
Which odds are you won't.
Odds are you won't. And this is assuming that mortgage insurance is the same cost on a 50-year versus a 30-year. Again, probably not the case. Assuming everything stays equal except you just go from 30 to 50 years, you save $300 a month on the average Utah house. If you stretch that to 100 years, how much do you think you save? Compared to a 50-year, so you save from a 30-year to a 50-year, you save $300 a month on the average Utah home. Going from a 50-year to a 100-year, how much extra do you think you save?
Maybe another $300.
$100 a month.
I would have expected way more.
It's because the amortization.
Yeah, the front load the.
You're just paying interest. I mean, it's practically an interest-only loan. So anyway, I was like, wow. So 20 more years of payment to only save $300 a month. That's crazy. And the interest is dramatically more expensive. Now, you and I have some opinions on that. We can dive into that later. But it's not a meaningful savings. Now, the 50-year, ironically, wipes out those other ownership costs that have gone up around $300 a month, which that was not even intentional. That just kind of hit me as I was talking. So it kind of wipes those expenses out, which is a value add, I guess.
Oh yeah. I mean, $300 a month is not.
It's significant.
I mean, that is significant. Yeah,
right.
For sure.
Yeah, for sure. But to go out 20 years, it's like, does it actually solve the problem? And so let's talk about that. The reality. Okay. That's best case scenario.
Well, and $300, like most people who are running into issues today, is not that they can't qualify, but people who have an issue buying, they're off payments like $600 plus, right? Double that.
And again, that's partly psychological, which we should talk about.
Yes. They qualify for it. Right. They're wanting a payment.
They don't want to spend that much.
Exactly.
Which is a dangerous, slippery slope. We should pin that for a minute. Let's go over that. But I want to talk about the reality of a 50-year or a 100-year mortgage.
Yeah.
Because best case scenario is you're saving a few $100 a month. The reality is 30-year loans are somewhere between a half a point and a full point higher than a 15-year loan. So you go from 15 to 30, 15 extra years, you're paying a half point to a point. Why? Because the risk is greater for the investor funding these mortgages to give you 30 more years to pay. There's more risk of the property going underwater because you're not amortizing the balance down as quickly.
Yep.
So there is a justified increase in the rates because the risk is greater for the source of the money. If you have more risk, you get better return. That's just the reality. So a 50-year mortgage, you can expect it's going to go up somewhere between a half to a point. 100-year mortgage, I think, is just like asinine and completely out of the question.
Right.
So 50-year mortgage seems somewhat, I guess, a realistic consideration on the surface.
Mm-hmm.
But if you go up a half a point to a point, the higher rate by a half a point erases the savings. There's no savings.
Yeah.
None.
Yeah, that doesn't.
You go up a full point, the payment's actually more than a 30-year. And we're seeing the same thing on 40-year mortgages right now. Those have been around for 5 to 10 years maybe.
But rates
they're higher.
Yeah, and they put the payment nearly 6s.
It's basically a 30-year payment. So it's like, okay, yeah, sure. Let me pay some more interest. Silly, right? So it's a cool, novel, interesting idea on the surface. It's like, man, this might be the solution. I would just say it's not. It's like...
Well, and like maybe the way that an investor can overcome increasing the rate to make up for the risk is they require higher down payments. But even then, we've discussed like that's
also
counterintuitive.
Barrier.
It's counterintuitive.
Yes.
Because now you're saying you have to come in with more cash, more skin in the game to eliminate the rate adjustment for stretching out the term longer.
Yep.
I mean, most people don't have the cash to cover that difference. And number two, oftentimes it doesn't even make sense to dump it into the house. If it's from a perspective of wanting to be in a better place financially, you're better off keeping the cash.
If you're thoughtful, if you're strategic, if you're not falling into this trap of what the media tells you and what your well-meaning family and friends tell you who don't know anything about, most of the time, don't know anything about finance, and like they're making emotional, illogical decisions or giving emotional, illogical advice based on their experience. And so the other thing is, which I mentioned earlier, is PMI would almost certainly go higher because like 15-year to a 30-year, PMI is like 50 to 100% higher. It's dramatically more. So a 50-year mortgage in all reality is probably going to be higher than a 30-year mortgage.
Right.
So now it's like, okay, what gives? And how do we solve for the affordability issue? Because we've pointed out there are real issues. It's really, truly more expensive to buy a house right now and a lot more expensive. And the barrier might feel insurmountable to home buyers, especially first-time home buyers that are not in the game. So I want to go over some of that stuff, but a quick little note is there are legal issues with this idea of a 50-year mortgage. That's because there is a qualified mortgage law in effect, and the qualified mortgage law restricts any mortgage over 30 years. It's no longer a qualified mortgage. What does that mean? That means that the bank issuing that loan that's greater than a 30-year loan has significantly more risk because there are not
There's no government backing.
There's no, exactly. You don't have backing. It's 100% on them. And they could be penalized. The law actually causes them to be penalized. They have exposure for up to like 10 years where they would have to write consumers checks for all the interest they pay if they make one little minor administrative mistake. So it's very risky. So you would have to, one, enable them to withstand the added risk of the extended prepayment and the risk of their assets. The home that you own is the asset backing the money they're giving you. If that goes underwater, well, the bank doesn't want to give you money. Obviously, you wouldn't want to give somebody money if you knew that, if they gave you a Snickers bar for collateral and they wanted $20, it's like, well, no, the Snickers bar is like 99 cents or whatever it is. Like, I'm not going to do that, So that's kind of the logic here. But you would also have to change the laws. Like, you would actually have to go change the laws. And we are coming off of, I believe the government is still shut down. It seems like it's going to open up soon.
Maybe.
Hopefully.
Yeah.
But we're going on like 40 some odd days of the government shutdown.
Yep.
And they haven't been able to pass that, even though there are families literally going hungry because they're not receiving a paycheck. They're not going to be able to agree on passing a law to change to 50-year mortgages, especially when this doesn't make sense. So I think it's a complete fallacy. It's I don't know what it is. Maybe it's a marketing scheme. Trump's a great marketer.
Yeah.
I don't know what it is.
It's a Trump tweet, man.
Yeah, for sure. So,
shower thoughts.
yes, right. So now it's like, what is the solution? How do you get in the game? Because the reality is, if you don't get in the game, you're just going to keep getting your ass kicked year after year after year after year. I just met with a buddy. He's helping me with a project in my house. He's in real estate too. Has been for like almost as long as I have. Probably a decade at least, I would say. He's been in. He hasn't bought a house. And it's because it's like, man, I don't know. I just don't have the taxable income. I can't afford the house I want. Da, 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 da. There's all these ruminating issues. This is pre-COVID. This is during COVID. This is post-COVID. You have record, like just super low home prices and maximum affordability in Utah over this span. And then now you go through the lowest rates ever in history through this span. And you come to this where we're really in an unaffordable, we're in the least affordable era of Utah homeownership than ever before.
Yeah.
And he still hasn't bought. But guess what? He's buying right now. Why? Because he's like, dude, I've gone 10 years and I kick the can and I kick the can and I kick the can.
And it doesn't get better.
All my buddies have bought. And guess what? They've got hundreds of thousands of dollars.
Yeah.
What the hell did he do? Like, he just screwed himself.
Or maybe they already upgraded once or
For
twice.
sure. But they still have hundreds of thousands of dollars in equity or cash if they sold it. You know what I'm saying? So it's like, you got to get in the game. So how do we do it? Obviously, like, shed the ego a little bit. Just buy some freaking real estate, because the actual home you buy does determine the price of the home. It doesn't determine really how much you make in profit, because it's location, location, location. That's the coin phrase of real estate, has been forever.
Yep. Land
is what goes up in value. The building actually goes down in value.
Yeah.
Because there are costs.
Right.
It is a depreciating asset. You get tax benefits on an investment property because it's depreciating. It's becoming worth less every single day. So it's the
damages,
land.
All sorts.
Exactly. So you just got to buy something. Get in the game. So I'm like, all right, buy something smaller. Buy a fixer-upper. Buy something further out. Be willing to sacrifice the commute. Or frankly, in this day and age, like, almost everyone has the ability to work remotely at least part way.
Partial throughout the week.
So it's like, go, add 30 minutes to your commute. You'll get some property and you will make money.
Yeah. Yeah, for sure.
Other ideas, co-invest with a friend or family member. If you've got somebody who's capable, a family member, let's say, they can help invest capital into this deal for you to do a multitude of things. Fund a down payment, but also fund extra cash to subsidize monthly payments. They can help buy down interest rates, which, ironically, if you buy down your rate by a point on the average Utah home, by 1%, you'll save about $300 a month.
Yeah.
Equivalent to that 50-year mortgage, but now you're on a 30-year mortgage, and that's a permanent savings, and you're getting more and more equity because you're on that term and the rate's lower. That you can get from a seller on basically every deal right now in Utah.
Yeah.
1%. So, but the other thing that we mentioned, like drive a cheaper car, make the sacrifice, sell the flipping car, like get rid of the lease. You don't need the freaking Mercedes-Benz. Like go
$800 plus a month. Yeah.
Right. I mean, it's crazy. Just go pay cash for a damn junker. Who cares? Get you from point A to point B, keep your family safe or you safe. Skip the vacations or just reduce the vacations. It's like, do you need to go to Hawaii? No. You could, go get an Airbnb up in Heber for a couple of nights for cheap, a couple $100, not a couple thousand to go on a vacation. Cut non-essentials. Do you need the subscription? I know that a lot of people are like, the coffee is not going to make a difference. The subscriptions, it's like, but it is. Like 20, 30, $50 a month. Well,
if you add it all up, if you choose to cut out one little thing, it may not make that big of a difference.
But they compound.
Right.
And here's the thing with housing specifically, that is the true source for the most, it's the most certain path to wealth for virtually every United States of America family.
Right.
$50 a month, if you can just eliminate those expenses, which I'll bet you every person listening could eliminate $100 to $200 a month in expenses, arbitrary expenses.
Yeah.
$50 a month allows you to afford approximately an extra $10,000 in a house.
Mm-hmm.
So $200 a month, you now can afford an extra $40,000 in a house.
Right.
That changes the dynamic quite a bit. Probably makes the commute a little less, get you a little nicer home. There's a lot of things that it does. So those are some ideas that I'm like, okay, that's really how it is. But then creative strategies, which I'll just put a quick little plug here. You can go to loanselevated.com. Find in our resources, we have the Holistic Mortgage Planning ebook. This goes into depth of every strategy we work with all of our clients on, and it tells you step by step exactly how to accomplish a lot of these things despite high rates, despite high home prices. One of the things we talk about a lot in that book and that we guide our clients on is this idea of payment subsidy. I mentioned it earlier with the co-investment or the joint venture idea. If you've got 5% down on a $500,000 house, you've saved up $25,000. Well, as a first-time home buyer, you could, honestly, you could do 0% down pretty easily.
Yeah.
But let's just say you do 3% down. You carve off the 2%. And psychologically, most people are like, well, no, that's less money down and the payment goes up and I just want more equity and blah, blah, blah. You start to freak out about it. And that's because we've been programmed by a bunch of naysaying imbeciles, really, in my opinion. It's like you're not thinking about it. Like you're losing way more than you could ever gain. So anyway, instead of $25,000 down, you do $15,000 down. You put $10,000 on the sidelines. That $10,000, again, I just went over this, is going to increase your payment $50, maybe $60 a month.
Yep.
So if we look at that $10,000, it's going to cost you $50, $60 a month. But now you have $10,000. Well, $10,000 over 36 months could subsidize your monthly mortgage payment by $280 a month.
Mm-hmm.
So you just put that $10,000 in a money market account and you pay yourself a little dividend of $280 a month. Now that mortgage, instead of saving $60 by putting that extra money down, you've now wiped out $220 net in affordability on that, and then cut out some expenses and all these other ideas. But this idea of payment subsidy is a very significant tool you can use to leverage accessibility into a unaffordable housing market, and it gets you in the game. And then you spend a couple 2 to 5 years and you cash out and you have probably 6 figures, at least high 5 figures in equity, and you just rinse and repeat, but at a grander scale. And so you just got to push the time horizon out, really, and be thoughtful about how to do it.
Yeah. And I think an objection we'll get there sometimes is like, because we say that gives you flexibility in the short term, but also gives you time to see an increase in wage or pay down the principal amount and refinance and refinance when rates come down. Everyone's like, well, what if all that doesn't happen? Of course, there's always a chance there. But the fact is, like, if you're playing in the capitalistic game that is the U.S. economy, odds are you're going to rise as the economy rises. That's just how it works.
Well, the reality is it's always happened.
Yes.
Always.
Yeah.
Like next month you don't get a raise, but in a few years You know, and then the other thing is that you can be thoughtful about it. And this gets you in the game. So you, psychologically, you're thinking through it the right way, right? Yep. So you get your tax refund the next year. Well, guess what? You're a homeowner now. So your tax refund's probably going to be thousands of dollars larger. $5,000, let's just say, you're going to get in a larger tax refund.
Right.
But let's just say it's not even extra. You take your tax refund, you get $5,000 or whatever. That's pretty typical for families. Mm-hmm. You now, instead of spending that frivolously or going on the vacation or doing something like that, you pocket that $5,000 and throw it in the subsidy account, and you subsidize your payment for another
even more
2 years, right? Mm-hmm. Or even more significantly. And it's like there are ways to defer the risk. You can emotionally ignore these possibilities and just say, nah, it's too risky. And then you can look back in 5 years and you can be hundreds of thousands of dollars less wealthy than you otherwise could have been. You could be playing the same game in a more unaffordable market, in a market where home prices are more expensive, and you could never catch it. And then you can look back when you're 40 or 50 years down the road and say, damn, I should have bought that house. Because then I wouldn't have to rely on Social Security that may or may not be here. Yeah. Or then I would have a more fruitful, enjoyable retirement. Then my family may not have to rely, or I may not have to rely on my family so much or my kids so much. Or, you know, I might be able to leave a legacy, a financial legacy for my kids and you know, leave something behind because of these simple decisions and sacrifices. Like,
yeah. And I always like to point back, I've been talking about Gen X now for a while.
Yeah.
And I can't remember the exact stat. They make up, I believe it's about 25%, and you might have to double check this, 25% of the nation's population.
Gen X?
Yes.
Okay.
But they spend like 30-something%. So they outspend what their actual population is.
Oh, interesting. Yeah.
And I don't think that that's a mere fact of just making more money.
Like, damn, it's only 20%.
Okay, so it's even less.
Yeah.
And I believe this is of the world's economy. They spend like 30-something percent.
Oh, wow. Let's see.
So you'll need to double check me before I continue on this, but the fact that I'm trying to make here is they outspend their population percentage by a good majority.
And that's who's giving the advice to these younger homebuyers.
Exactly. Right, 100%. But they don't realize that they had to make sacrifices. They bought early on, right? They bought when they were young adults, made some sacrifices. And it's not a matter of they're making more money right now. It's the fact that they have expenses. Their second biggest expense outside of taxes. Everyone's second biggest expense is housing, whether you're renting or you own. And these guys have $1 million homes or more, a lot of them, but their payments, if they stayed out of debt, are, less than a couple $1,000 a month.
Right.
On at least a majority of them.
Yeah.
So they just have more residual income that they can spend, but they're also, 50, I can't remember the age cutoff. It's like, 80, 81 or 1981, anything before that?
Let's see. Hang on.
Regardless, they're in their
1965 to 80.
Okay, so yeah, they're in their 50s, 60s. Now they have all the residual income to go out and do the vacations and have the fun, and that's why they're spending so much because they've fixed their.
But the reality is, dude,
we don't ever look at the inflation fighter that housing can be, owning real estate, because yes, there are some variables, there are some costs that can go up, taxes, insurance, whatever.
Right.
I'm not going to be that guy who says that can't change.
Right.
Your principal and interest payment, though, stays the same.
Right.
And over years, your income, as long as you're staying out of debt, that gap between your fixed expenses versus your income should grow and grow and grow if you do it the right way.
100%. One thing to plug in here that's important, I think, because these fixed expenses, taxes and insurance go up. Yes, that's a risk as a homeowner. We talked about utility costs going up. We talked about labor costs going up, so HOA dues go up or maintenance on your home goes up. Well, guess what? If you're a renter, all those costs are being passed on to you too. The landlord's not just out of the graciousness of their heart going to subsidize those costs for you. You're going to pay those costs no matter what.
Yeah,
those costs are
they're going to pass
to
those on to you, but then they're also going to set themselves up to where they're cash flowing because
right.
their mortgage payment is probably $1,000 less.
Right, 100%.
Than what your rent is. If you were the owner, you would pay $1,000 less for the same house.
Exactly. Yep. And you have to put a plug in it somewhere because it's running from you fast. You can't keep up with it, right?
Yeah.
It's not going to work.
It's just crazy how powerful debt service can be on an asset like real estate.
Yeah. Yeah, it's crazy. So I did pull that up. So it's apparently they're like 19 to 20% of the total population, and they're responsible for 33% of the consumer spending in America, in the United States.
Yeah.
That's wild.
Freaking nuts, huh?
Way overspending. And the stupid thing is, when I get in the business, that's who I was serving. Was because I'm a millennial, and I think I'm like a mid-tier millennial, just right in the middle.
Yeah.
They were the clients that I was working with.
Yep.
They all are debt burdened. They all have all the toys, all the cars, the big house. Like, keeping up with the Joneses is a real thing in that generation, largely. And it's like, again, they are the parents and the grandparents of these homebuyers nowadays.
Yep.
Giving the advice is like, I'm not saying that we're the smartest people in the world, but I am saying that, like, you've got to lean on resources that actually know things and dissect the logic of what you're hearing and make a decision on your own. But make sure that you're dissecting this logic. I mean, we have ChatGPT that can really help with this, which honestly I think is a great thing for us and younger generations. But anyway, we're getting on a little bit of a tangent here. So the other thing is, like, if this 50-year or 100-year mortgage worked, the government would have to step in and subsidize in some way.
Yeah.
I'm just not a fan of that. It makes it more expensive. The COVID boom was a result of government subsidizing the economy because of quantitative easing. Quantitative easing caused the rates to go low. Low rates caused...
I mean, anytime you see the government step in and offer
help, the consumer pays.
It somehow, some way, it's always going to come back. Someone's going to catch the bill.
But not someone,
it's
you
the
and
taxpayer.
I.
It's the consumer. Exactly.
Right.
That's what I was getting
Every
to.
person watching
the
is catching
taxpayer
it.
will end up catching the bill at some point.
But let's not make it so abstract. The taxpayer, someone, no, you are going to be catching the bill. Yeah. You are going to pay for it. Your kids are going to pay for it. It's going to be more expensive for you and your family. You and your family, me and my family. Yeah. That's who's going to pay for it. Right. It's a bad idea. Like, take some accountability. Get strategic. Like, capitalize on the capitalistic market we live in. Be grateful that we live here.
Change a lot, dude. I think just financial education.
Absolutely.
If they really, that's what I think is the true answer to the economic future in the U.S. and affordability in general.
Yes.
Financial education.
Right. Because it's not.
We're lucky that we have
issue.
social. Like, if it's in your algorithm and it's something that's important to you, you're probably picking up on some good stuff today. Which I would say, like, there's probably a good percentage of younger millennials or millennials and Gen Zers, if they choose to, because we have access to it right here on our phones, probably have a better financial education than any of their
or at least the opportunity
or
for
generations before it. Yes, opportunity for it.
Yep, for
it's
sure.
Accessible right in your hands. Like, that's the best way that you can make a situation more affordable again for your family.
Yep.
You have to be. You can't avoid it. You have to know. You have to understand finance to a level.
100%, yeah. And you got to take accountability. So I think the answer is 50 or 100-year mortgage, throw it out the window. Terrible idea. Housing is more expensive. Housing is not, for most people, actually out of reach. It is within reach. If you're willing to do the right things, if you're willing to take advantage of the right strategies, lean on the resources. Yeah. So we encourage you, lean on somebody. We would be grateful to be that somebody. We know this stuff, and we are thoughtful and creative in helping people accomplish homeownership, because in our heart of hearts, what's important for me, anyhow, in this industry, is showing people a path to real financial freedom and real generational wealth. And this is accomplishable by just by buying real estate. One house, maybe two houses. You can literally become a multimillionaire through this process. So we would be honored to help you through this process. But if we're not the person, I encourage you, figure it out. Find a way to get in. We know that there are hurdles. We know it feels insurmountable. We know that all the talking heads are saying that housing is unaffordable and you shouldn't do it, and there's a bunch of fear-mongering. They're wrong. Look, in any stretch in history, over a 10-year stretch, the long-term investment of real estate always wins. So don't get fooled. Thank you all for tuning in. Please be sure to comment, like, subscribe. I would love engagement on this episode because there's some really heavy opinions here and some contentious topics we're talking about. Please comment. Tell us what your thoughts are so we can understand what people are feeling, what people are hearing, and how you're making decisions. It would be really helpful for us in the channel. So, cool.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.